Good morning and namaskar. The West Asia conflict continues to challenge the global economy by disrupting key trade routes and supply chains, amplifying market volatility, and repressing business sentiments. Trade uncertainty lingers as US imposed fresh tariffs. The global economic environment has become increasingly unstable. Global growth is projected to soften, while inflation forecast is higher for 2026 vis-a-vis the previous year 2025. Some central banks have tightened policy, others remain vigilant. Crude oil prices, currencies, and financial markets remain volatile, fluctuating in line with the changing intensity and the uncertainties of the West Asia conflict. In this backdrop, the Monetary Policy Committee met for its third bi-monthly meeting of this financial year on 3rd, 4th, and 5th, that is today, to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments, as well as the outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the SDF rate shall remain unchanged at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for these decisions. The MPC noted that headline inflation has edged up above target as expected. The realized inflation for Q1, however, remained marginally lower than projections, reflecting limited pass-through of cost pressures. The higher inflation is mostly on account of fuel and food, with little signs of generalization of price pressures so far. Core inflation, excluding precious metals, continues to be benign. As projected earlier, headline inflation is expected to rise further in the near term. It is expected to peak in Q3 of this year, primarily again due to food and fuel, and thereafter moderate. The underlying inflation reflected by core inflation excluding precious metals, which has been benign for some time, is set to align with core inflation towards the end of the financial year. Growth continues to be supported by the resilient domestic demand, sustained expansion in manufacturing and services activity, and robust exports. It reaffirms India's position as the exports. It reaffirms India's position as the exports. It reaffirms India's position as the world's fastest growing major economy. To sum up, the MPC noted that even though headline inflation is projected to increase, it is primarily on account of supply side pressures caused by food and fuel. It is not getting broad-based. core inflation continues to remain moderate, and it is expected to decline after peaking in Q3. Growth, albeit resilient, is expected to be lower in this financial year. The outlook, however, is hazy because of the uncertainties regarding southwest monsoon, El Nino, geopolitics, and global trade policy. There is a need for greater clarity to emerge, especially regarding inflation, its path, and composition before taking any policy action. Any such action would also have to consider the need for recalibration of policy rates in line with the evolving growth inflation dynamics, especially the normalization of the underlying inflation from its benign levels seen hitherto. Considering all these factors, the MPC voted to keep the policy repo rate unchanged. The MPC also decided to retain the neutral stance to respond appropriately to macroeconomic developments. The MPC underscored that it will maintain a close vigil and remain resolute in its commitment to align inflation with the target. I will now come to our assessment of growth and inflation. Let me first of all talk about growth. The supply side pressures caused by the West Asia conflict have eased somewhat since June 2026, leading to withdrawal of temporary measures undertaken by the government and normalization of key input supplies. However, the re-escalation of the conflict since the first week of July has amplified volatility in energy prices and renewed uncertainty about supply chains. Amidst persistent global uncertainty, domestic economic activity has exhibited resilience as reflected by the high-frequency indicators available for Q1. Early results of corporates for Q1 indicate healthy performance in the manufacturing sector. This is also corroborated by an expansionary PMI. Services activity too maintained its momentum in the wake of strong domestic demand. Private consumption continued to be driven by buoyant discretionary spending. Investment activity remains steady on the back of robust government spending on infrastructure and construction. Merchandise exports rebounded with double-digit growth. Services exports growth sustained its momentum. Overall, the Indian economy performed better than expected in Q1. Looking ahead, the prospects for agriculture are clouded by deficient and uneven southwest monsoons amidst El Nino conditions. The reservoir levels, which remain close to normal, bode well. The government's initiatives for crop diversification, including short duration as well as climate resilient crops, and water harvesting and conservation inter alia, are expected to mitigate the impact of deficient rainfall. Although manufacturing sector may face cost pressures, the growing diversification of global supply chains should help mitigate the impact. Services sector is expected to maintain its buoyancy on the back of strong domestic demand. On the demand side, impact of weak monsoon on rural consumption may be partly offset by supportive allied sector activities and various government schemes. Buoyancy in services sector and steady employment conditions should support urban consumption. Strong capacity utilization, robust credit flow, and the government's continued thrust on infrastructure are expected to sustain investment activity. Net external demand is expected to derive strength from bilateral trade agreements, many of which have been recently concluded. and some of which are now being operationalized, as well as the market diversification efforts of our manufacturers. Renewed tensions in West Asia, which are disruptive of global supply chains, volatility in international financial markets, and weather-related shocks, however, pose downside risks to growth. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.7%. This is 10 basis points higher than our previous projections. Q1 at 7%, Q2 at 6.4%, Q3 at 6.5%, and Q4 at 6.8%. The risks are evenly divided. Let me now talk about inflation. While CPI inflation increased to 4.4% in June after remaining below target for 16 consecutive months, it turned out to be lower by 30 basis points than what was our earlier projections. The increase in June was primarily due to higher food, fuel, and fuel-induced inflation in select categories such as restaurant services. Notwithstanding the pressure from higher input costs, core inflation, which excludes food and fuel, remained unchanged at 3.9% in May and June. Core inflation, excluding precious metals, was even lower, 2.3 to 2.5% during this period. Going forward, El Nino impact on temporal and spatial rainfall distribution continues to remain a major risk, although proactive supply management and adequate stock of food grains should provide comfort. Global oil prices have remained highly volatile, with sharp two-way movements triggered by geopolitical developments. This blurs the near-term outlook. Although generalized inflation pressures continue to remain modest so far, the risks of second-round impact of higher food, fuel, and other input prices translating to broad-based inflation persist. After considering all factors, CPI inflation for this year is now projected to be 5%, 10 basis lower than our earlier projections, with Q2 at 4.7%, Q3 at 5.9%, and Q4 at 5.5%. Inflation for Q1 is projected at 5.3%, with risks being evenly balanced. Core inflation is projected at 4.3% for this financial year. Core inflation, excluding precious metals, is projected to be lower than core, although it is likely to align with core inflation towards the end of the financial year. Let me now talk about liquidity and financial market conditions. System liquidity, as measured by the net position under the LAF, the Liquidity Adjustment Facility, stood at an average daily surplus of 1 lakh crore rupees since the last MPC meeting. Going ahead, the usual return of currency during the monsoon season, drawdown of government cash balances, and our special measures to attract capital inflows are expected to aid banking system liquidity in the near term. Since the June meeting, the Walker weighted average call rate traded within the policy corridor. It averaged 5.31%. Short-term money market rates, especially rates of commercial papers and certificates of deposit, moderated in July. G-Sec yields, buoyed by measures undertaken by the government and the Reserve Bank to attract foreign capital into Indian debt markets, eased across maturities during June and July. Transmission in the credit market, however, moderated slightly during May and June with hardening of deposit and lending rates. Nevertheless, credit growth continues to remain robust and broad-based across various sectors. Through its conduct of two-way operations, the Reserve Bank will proactively ensure sufficient liquidity in the banking system, guided by the objective of aligning the Walker to the policy repo rate. I will now speak about financial stability. As mentioned earlier, the system level financial parameters relating to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. There is, however, some moderation in NIM as compared to last year. Similarly, the system level parameters of NBFCs too are sound with adequate capital position, improved gross NPAs, and higher profitability. Let me now turn to the external sector. Despite the challenging and turbulent global macroeconomic environment, India's current account deficit last year remained modest, much below the levels considered to be sustainable for emerging markets. During April to May this year, the current account recorded a surplus of $2.8 billion US, primarily led by services trade and strong remittance receipts. In Q1, India's merchandise trade deficit widened to about $86 billion from about $69 billion in Q1 of last year. This is mainly driven by imports of crude oil, electronic goods, and gold. Going forward, moderation in global trade growth, surge in energy prices, and persistent trade policy uncertainties pose upside risks to India's current account deficit. On the other hand, implementation of the India-UK trade deal, along with many other recent agreements with major trading partners, healthy services exports, and buoyant inward remittances are expected to mitigate these risks. On the external financing side, gross FDI inflows were buoyant at $30.7 billion in the first quarter of this year. They are higher than $26.7 billion in the same period last year. This underscores the continued interest of global investors in India. Net FDI inflows also mainly driven by higher gross inflows and a slowdown in growth of outward FDI increased during the period. Moreover, FPI to India has seen a turnaround in June and July this year with net inflows of $7.1 billion. This is, of course, primarily driven by the debt segment and after registering net outflows during April and May of this year. Going forward, capital flow measures undertaken in June will support inflows. As a result, the balance of payments is expected to register a healthy surplus. India's foreign exchange reserves continue to be adequate in terms of the standard metrics of reserve adequacy, with import cover of over 10 months and external debt cover of almost 91%. As for the exchange rate, as mentioned earlier, we will continue with our policy of it being determined by market forces, while at the same time curbing excessive volatility, checking speculative behavior, and preventing disorderly movements so as to ensure that it is not out of sync with the fundamentals or it is not disruptive of economic activity. For this purpose, we have a very broad range of effective regulatory and market-based instruments. Now, before I conclude, as has been the practice, I have a few additional measures also to announce. I have two measures to further strengthen the cooperative sector. One, on the basis of the feedback received on the discussion paper on licensing of UCBs, which we had done some time ago, we are now issuing draft guidelines for resuming licensing of the urban cooperative banks. Two, in light of the experience gained and the developments since 2008, when the credit monitoring arrangement for rural cooperative banks was last revised, we are issuing draft directions after undertaking a comprehensive review of this arrangement. There is one measure for interest rate on advances. In order to enhance transparency in lending rates and further strengthen consumer protection, it is proposed to harmonize and standardize the regulatory framework on interest rates on advances for all regulated entities. To conclude, global economic conditions and sentiments continue to remain hostage to the rapidly oscillating developments, both in scale and intensity, of the West Asia conflict. While these have impacted the domestic growth inflation outlook adversely, the stronger macroeconomic fundamentals of the Indian economy are helping navigate this global shock resolutely. As alluded to in my last statement, this presents an opportunity to accelerate measures to enhance our resilience to withstand